is a short demo lecture about one of the CFA topics. Basically, if I want to talk about the financial statement analysis, we should know that we have many types of financial statements, starting with the income statement, the balance sheet, and the cash flow statement, besides what we call financial disclosures. If I would like to define an income statement, it shows the operating performance of the firm over a period of time. So if I would like to tell what is the operating performance of the firm in terms of revenues, expenses, profit or loss, I can look at the income statement. Why? If I want to have an idea about the financial position of the firm, about the firm's liquidity, solvency, leverage ratios, I can look at the balance sheet. This is why we can say that the balance sheet, it shows the financial position of the firm at a specific period of time. The third financial statement that we can talk about within this short demo lecture is the cash flow statement. It's very important to have an idea about the cash level available for a certain firm and the sources of the cash. Whether this cash is generated from operating activities, investing activities, or even financial activities. All those three financial statements, they are quantitative financial statements in nature. If I would like to have more understanding about those financials, we should have what we call the disclosures. Those disclosures, they include explanations about the financial statements that we mentioned: income statement, balance sheet, and cash flow statement. What are the major components for the income statements? Basically, the income statement is classified into three basic categories. The first one is called the operating income. Whenever we talk about operating income, basically we're talking about the income that is generated from the firm's principal business, core business. So whatever revenue or expense that is directly related to the firm's business will be under what we call operating income. However, we might have some income, some expense that is not directly related to the firm's core business. This income will be recorded below the operating income under what we call non-operating income or income from continuing operations. So basically, the major difference between the operating income and the income from continuing operations is that the operating income only includes the income that is related to the core business of the firm. Why? The income from continuing operations, it includes income that is directly related to the core business plus any other income that is expected to recur in the future. This is why we call it income from continuing operations. And then the third level of income that might be available in the income statement is the income from discontinued operations. Again, we might have a certain revenue, a certain gain, a certain loss that is not expected to recur in the future. It's a one-time event and that's it. Whenever we have this discontinued operations, any income or loss that is not expected to recur in the future, I classify it as income from discontinued operations. And then the sum of the operating income, the continuing income, and the discontinuing income will give me the ending result, which is the net income. The question is, why shall we classify this income statement based on those three levels? Why should not provide only the net income to the end user? Because it's very important for the end user to be aware about the source of income, whether this income is expected to recur or not, whether this income is generated from the core business of the firm or not, so that whenever I have a net income of X dollar, I can tell for sure that this is related to the operations, that this is a continuing income, that this is a discontinued income, so that whatever decision I take based on the net income will be a valid decision. So this is the income statement and its importance in analyzing the firm's profitability. If I would like to go to the balance sheet, basically the balance sheet can be classified into three major categories: assets, liabilities, and owner's equity. Whenever we talk about assets, basically we're talking about a certain cost that is expected to generate a future economic benefit. So whenever the firm incurs a certain cost and this cost is expected to generate a future benefit for the coming period, I will capitalize this cost as assets. On the other hand, we might have some liabilities, commitments that the firm should settle, obligations that the firm should perform. So those commitments, those obligations will come under what we call liabilities. So whatever commitment on the firm will be under the liabilities, a certain sacrifice of resources that should be settled, that should be paid off, that should be rendered at a certain date in the future. On the other hand, we have the owner's equity that basically represents the residual claim of the investors, assets minus liabilities. Within the stockholders' equity, we can segregate between the different types of capital, common stocks, preferred stocks. We can look at the retained earnings, the accumulated earnings after paying the dividends. And we can look at what we call other comprehensive income, any income that bypass the income statement directly toward the balance sheet. So this is why we can say that the financial position of the firm might be analyzed through the balance sheet, because I will have a clear idea about the company's assets, liabilities, and equity. On the other hand, the third financial statement, which is the cash flow statement. As we said before, within the income statement, we can see the net income. If we have a net income of X dollar, it doesn't mean that I have cash available of X dollar. We might have more than this amount or less than this amount. So that I would like to calculate what we call the cash flow statement. This cash flow statement, it reconciles the net income to adjust this net income toward the cash available at the firm's accounts or at the firm's banks. So that this cash flow statement, it shows the amount of cash available and, which is more important, the cash source of this operation, whether it is from operating activities, investing activities, or even financing activities. What is the difference between operating activities, investing, and financing activities? Basically, whenever we talk about cash flow from operating activities, we're talking about the inflow of cash and the payment of cash related to the firm's operations. Why? When we talk about investing activities, again, we'll be talking about the inflow of cash and the outflow of cash, but this time, the cash that would be related to the investing activities, related to the purchase of assets, related to the acquisition of investments, related to the issuance of a certain new investment. This would be CFI. The third cash level might be related to the financing activities. It includes any inflows of cash or outflows of cash related to the financial activities, which means any inflow of fund related to the capital structure, related to the dividends payment, to the issuance of common stocks. So any activity related to the capital will be included in the CFF. The sum of the operating cash flow, investing cash flow, and financing cash flow would give me the cash flow for the period. Again, why shall we segregate between those different three cash levels? Because for the analyst to be aware about whether this cash is from operating sources, investing sources, or financing sources, I would like to look at the cash flow. And it really makes a difference. Whether this cash is generated from operations, it means that it's generated from the core business of the firm. While if it's generated from financing activities, it might mean that this is through a bank loan. So it really makes a difference to know what is the source of the cash flow. Then, the explanations of all those financial statements which would be included in the footnotes, in the financial disclosures. For example, if within this balance sheet I have an accounts receivables of $1 million, it really makes a difference if this $1 million is due from one customer or it's due from several customers. Within this balance sheet, I cannot tell whether it's due from one customer or several customers. While in the footnotes, in the financial disclosures, we might have the explanation of this accounts receivable that tells us that the account receivable is due from this customer or done from many customers. So that I would like to have a clear idea about those financial disclosures in order to have a certain decision making that is in line with the investor's good position. So basically, whenever we have those financial statements in place, we can analyze those financials and then we can get a clear understanding about the position of the firm, about the potential growth of the firm, and whether this firm is a good opportunity for the investor to invest in, or no, we should look for another investment. So So basically, this is a demo lecture related to financial statement analysis, which is one of many topics that are basically related to the workplace in the finance industry.